it's sort of moved on slightly. So yeah, we'll talk about that. Here's me. Many of you know me, I think. Uh, I'm going through the budget changes. I'm mentioning the election manifestos and also just some of the things that we might be doing now that some of our clients are thinking about doing before the election and beyond. There's a bit of background on Crowe. I'm sure this will be shared after the meeting. The budget changes. These were the ones that I sort of mentioned last time. But of course, some of these haven't actually gone through. So the budget announcements that I picked up on were the removal of multiple dwellings relief. That's enacted from the 1st of June. If you exchange before the budget in March, then actually you can still complete and claim that. And for those of you who bought a house with an annex in the last 12 months and didn't consider it, there's still time to make an amendment to your SCLT return. So we are still talking to people about MDR, but it's a big change. And we'll talk through the numbers again briefly. The new capital gains tax rates have been enacted from the 6th of April 24. These are for residential property where you're a higher rate taxpayer. So there's a small reduction in CGT. We'll talk about that. The main rate of NITs was reduced by 2%, so that was enacted. And so was the child benefit threshold, which was the rate at which the level at which it starts to get withdrawn was increased to 60 grand. The removal of the furnished holiday lets has been extensively lobbied, and there's no legislation on that. The finance bill post the budget went through, and there was no mention of changes. So there is speculation that that won't happen, but we will see. And the changes to the non-dom rules as well, no legislation and very complicated changes there. So obviously that is a Labour manifesto pledge, that one. So we will see change there, but how quickly is anyone's guess. So we'll talk a bit about that too. So, I mean, MDR, just to remind you, it was really designed to help people buying multiple dwellings at one time, because the way the SCLT system works is it's kind of a tiered rate, a bit like income tax. So if you buy lots of dwellings in one go, then without it, you pay a higher rate of SCLT. And so, as you can see in this example, if you've got someone who buys 5 dwellings under the new rules with the abolishment of the SCLT charge, they'll pay 361 grand, whereas they would have paid 177. So it's a huge difference for a 5-dwelling purchase in this scenario, where they're spending 3 million. So that's particularly impacting build to rent type people, people who are buying, student accommodation in a block or something like that. What the good news is, there is still a rule that if you have 6 dwellings or more, then you default into the commercial rates, the non-residential rates. So someone who buys 6 dwellings goes from paying 361 in this scenario down to paying 139. There's still, an opportunity to get a lower rate on residential property if you buy 6 or more dwellings. But in the absence of that, you're going to be paying a lot more. And it was really people were using it because of annexes and really taking advantage of the rules. So the revenue, or the government, brought in a very tough result, which was to withdraw it, which has hit, probably people who shouldn't have been hit by the change. CGT rates, the change. There's a lot of stuff in the slide, but it's not really saying very much other than the rate under the old rules was 18% in the basic rate band and 28% for higher rate taxpayers, and that 18% staying the same. The 28's gone down to 24. So it's not really, it's 4% on for higher rate taxpayers, but that's nice. So that's encouraging, I guess, the property market still. There are other rates available for CGT. So commercial property is lower at 10 and 20%. Other assets are also lower at 10 and 20% generally. So that might be things like shares. But then this one is the one that's kind of been mooted in the press, and it's created quite a lot of angst for private equity people, which is carried interest. And that rate didn't come down in the budget. It's still at 28% for higher rate, but it's 28% is significantly lower than 45%, which is the top rate of income tax. So that's where the Labour Party are going for that rate of tax. So we'll come on to that as well in a bit. The NIC change, for anyone earning anyone earning 100 grand or more, or actually it's this level, isn't it? 75, they'll be saving 1.5 grand a year. So this applies to everyone and benefits the higher earners more, but it's capped at 1.5. The Tories have said that they would bring it down by another 2%, so that's worth another 1.5 if they were to be elected. So we'll come on to their manifestos later. And then the child benefit clawback. Here's an example of how the clawback works, depending on how many children you've got. So your child benefit's worth quite a lot of money for people. If you've got 3 kids, it's worth 3 grand a year, but it gets clawed back between 60 and 80,000. You just need one person in the household who's earning over 60 for that to be withdrawn slowly. So that threshold was previously at 50, so it's gone up a bit, and it's being extended. It used to be over £10,000 of income, whereas it's now over 20,000, the clawback. So it will help a few people definitely, but again, the higher earners really. And then on the furnished holiday let, this is the controversy. If you've got a furnished holiday let and you pay loan interest, so a lot of people do use or do have trades of letting their property or down on the coast, and the government brought in rules that actually sort of effectively restrict interest relief on residential property, but they didn't apply to furnished holiday lets. So if they bring in this proposed change, which would be a cliff edge, is the old rule where they brought it in for residential property was phased in over 4 years. But if they just abolish furnished holiday lets, then in this scenario, which we've got here, where you've got someone with 70 grand of rental income, they've got 12,000 of expenses and 40,000 of interest, which is obviously a heavily leveraged property. Under the existing rules, they've got 18 grand of profit, and they pay, if they're a higher rate taxpayer, £8,100 of tax, so they're paying 45%. Under the new rules, if this has got brought in, then because you don't get relief in the same way for the loan interest, your tax liability then goes massively up to 26,000, and your credit for the loan interest is restricted to 20%. So you only got 8,000 of relief. So you end up paying 18 grand of tax on 18 grand of profit. So, your marginal rate goes from 45 to over 100% in that scenario. And that was the real problem under the old rules for property. And it forced a lot of people into looking at incorporating their property portfolios and things like that. And, it's harder to do that with a furnished holiday let because a lot of people use them for part of the year. And if you use a property for part of the year, it doesn't work well if you've got it in a company. So that's just one of the measures that's caused a lot of angst, as well as removing the business asset disposal relief rate, and also it doesn't count as this currently counts as earnings for pensions. That would be removed. So I'm not convinced this will come through, but I just wanted to flag it again. And then on the residence non-dom rules, I'm not going to go through the slide because it's very niche, but there's some big changes planned there, and there's some stuff on the slide there. But I will talk to you about the impact of this is having on my clients, because it is impacting people and making them make decisions. So yeah, there is also, it's not being published, but I think with this non-dom removal, there's some fundamental changes they're going to have to think about with IHT. So, I think that if they're going to attack this or deal with this, I would not be surprised if IHT was looked at in a bit more detail as a result of this, because it's going to take a couple of years to go through this. So I'm speculating we'll see quite a bit more change here. No one's talking about a wealth tax yet, but Labour said they're not planning on doing it, but it would be quite easy to really reform IHT because of the amount of change that's needed anyway as a result of this change. Shall I keep going, or does anyone have any questions at this stage? Keep going. How am I doing for time? I'll try and speed up. The election manifestos, you'll have all seen these. This is the Liberal manifesto, which sees sort of a large amount of revenue and a large amount of spending, 26 million quid. A lot of the reform involves, effectively equalising capital gains tax rate, also aligning that's basically income tax rates with capital gains tax rates for higher earners. So that's a big change, and then hitting the banks broadly. And then you've got this sort of tackling tax avoidance and evasion figure, which we'll come on to, is a sort of familiar theme in all the manifestos, which is it's really a kind of slush fund number as far as I can tell. So that in terms of this Labour manifesto CGT rate thing, I just thought I'd put up a slide which shows how the sort of announcement of possible changes really skews the market. So what you see here is changes in the CGT rate over the years. You got it going from 30% to 40%, and then went down to 18%. Then it went up to 28%, and now it's down at 20% for the main rate. And how it kind of creates just pre-change a huge peak in actual taking in terms of revenue, and then it kind of falls off. So the result tends to be overall that it doesn't really necessarily bring in a lot of extra tax, but it does produce a kind of brief windfall. So I think there would be a lot of extra transactions this year and in the future if they were to increase the rates. The Tory manifesto again. I don't know if anyone's actually read any of these things, but again, it's sort of actually their manifesto is all about reducing tax, so massive tax reductions across national insurance, self-employed national insurance, age-related personal allowance for pensioners to kind of give them an additional lock, reducing the high income child benefit charge, which is that child benefit charge, by moving to a kind of household income assessment of income. So all these things are just like, giving away stuff, but sort of matched with welfare and tax cap figures, which again are not clearly identified. So it doesn't look entirely funded in my view. Um, and if you look at this tax gap figure, the Lib Dems have got this figure of 7.2 million throughout. The Tories sort of increases to 6, and the Labour have got it going up to 5. But it was quite interesting. The Labour document said the chief executive of HMRC has said for every marginal pound that HMRC spends on compliance, there's a return of £9 in additional tax revenue. So basically, what it is give the revenue more money, and we'll make you a massive profit. So that's the plan, to just give the revenue more money. And to be fair, I don't disagree that they need more money, because they do, because they're a nightmare to deal with. But whether it will actually reduce or increase the tax take is yet to be seen, I think. And then the Labour manifesto again. This is quite a lot more detail in this. I thought it was the best of the ones I've seen. I haven't put the Greens up, but It's got a lot more detail in it. It looked more like a manifesto for the next government, in my view. But this is not a political presentation, but it does feel. I think the general view is that this is more likely to happen than not. So yeah, the school fees thing we'll talk about again, the carried interest bit, the non-dom bit, and then windfall taxes. Um, One of the things I just find amazing though is that people don't really talk about the debt and the fact that the government is in such a pickle, really. So when you look at the spend in 0708, the government spent £587 billion a year on stuff, and now they're spending more than double that, at 1.2 over 1.2 billion. But it's this, I mean, it's this debt interest figure that's just so terrifying, isn't it? 109 billion a year in debt interest, which has gone from 30 to 109. And I don't think that the tour again. It's not political, but they've got to deal with that problem every year, and it's sucking money away from everything else. So it's got to be a priority to try and pay down that debt for the future, really. And then again, tax increases have gone up from 553 billion to 1.2 billion, and that's how it's split. Um, but it hasn't the actual proportion of taxes hasn't changed massively, other than the VAT. The VAT rate has gone up in the period since 0708, and that's now a huge chunk of the pie. So pre-election, VAT on school fees is something that a lot of people talk to me about. A lot of the schools are encouraging people to pay in advance of the election to secure a kind of VAT point, so that they don't have to pay VAT on future school fees. So we are talking to people about that, and a lot of the money is coming from grandparents. So setting up trusts for children is quite a common way of dealing with this if cash flow is a problem. So again, we can help you and your families set up the right structure to help with this sort of thing. Um, Pensions, there's nothing being mentioned about pensions, and there's a lot of words on this slide, but it's got a perennial issue. What you know, Rachel Reeves hasn't said that she is not going to do something with pensions, and they are still quite generous. And there's been speculation that they could reduce the marginal rate of income tax on pension contributions or get rid of the 25% pension pot, tax-free pension pot, or even possibly bring the whole of the pension within the scope of inheritance tax. Because in back in the olden days, you used to have to buy an annuity from your pension at 75, so it kind of died with you if you lived beyond 75. Whereas the George Osborne change meant that you can now like build up your pension pot until you die and leave it to your next generation tax free. So it's become an IHT tool as much as anything else, and that would be quite easy to change. But there's no mention of that at the moment. The only thing I would say is people are if they can, putting money into their pension sooner rather than later, in case there are any changes. And then CGT, I've mentioned about this whole carried interest increase in the rate on that, and therefore people wanting to accelerate transactions where they can. So we're doing quite a few transactions at the moment on business sales to get them away, and private equity people have got the same challenge. I think this coming back to I don't know, not the non-dom thing. This is definitely this combination of removing the benefits for non-doms and the carried interest issue is definitely making non-doms who are often wealthy and therefore have got private equity type investments really seriously look at moving. And I've got 3 clients at the moment who are in the process of leaving the country or saying they're going to. Whether they really will or not, I don't know. But I wonder if that's happening across the country, and therefore these numbers on non-doms savings, I just wonder if those will come to fruition. So yeah, what's next? Obviously, there's stuff on our website already about the manifesto, but there's more stuff will come up on that. It'd be great to have a face-to-face budget get together. I think we should probably try and do that. So we'll get that in the diary when it eventually is announced for this expected in the autumn. And if anything rings or anything here is useful, just get in touch. That's it.
Crowe have launched their own kind of manifesto for manufacturing. The manufacturing sector is a big sector for the firm as a whole, and so we've actually kind of launched this over the last week, and this was built on sort of reports that we've done over the last kind of year or so, and we've got feedback from the manufacturing community. And principally, it came from the fact that we felt as a firm that there was a need for a minister for manufacturing within whatever political party gets in or is around. And because there's just nobody who really truly understands actually the majority of the manufacturing sector. They understand what goes on in the big firms, but they don't really understand what the majority of the manufacturing sector needs. So that was kind of the push. So we thought we would then provide our own manifesto and get some sort of momentum with that. So these are the people. So we've got, and we'll share these slides via Suzanne with you afterwards, and please forward them on to anybody you know within the sector. So even if that's not you yourself, but please forward it on. There's these QR codes and things where you can actually launch, and the manifesto is 20-25 pages long. So but I've picked up a couple of the highlights anyway. So what we've kind of done here, there's just a few slides where we've basically pulled out what we think are the key areas within the sector and the reasons why. Obviously the document provides far more detail within this, but this just gives you a flavor. So if you want the document sent through, just let me know. I think what we sort of, we've got a couple of quotes here, what we sort of felt from a manufacturing sector as a whole was that was really to kind of change the messaging, I suppose, around the sector, that it's not a dirty sector, it's not dangerous, it's not a dead-end sector, it's not badly paid and things like that. And I think actually we're trying to generate interest in the sector as a whole, and we're asking for a strategic review around the engagement with education within the manufacturing. Remember, this is what we're asking for from the government, and also sort of simplify the apprenticeship sort of system and the funding process and the tax credit based system for all of the apprenticeships within the sector. It's just too complicated at the moment, and it also doesn't get into you talk to the big manufacturers within the UK, they get a load of apprenticeships, they've got a load of funding. It's actually, 75-80% of the manufacturing sector are not the big boys. They're under 10 million turnover, under 20 million turnover, and they're struggling to get the funding for these apprenticeships. So we need that to be simpler. Obviously, then that links to the STEM projects and things like that. So there's a real push. We're asking for the government to really understand the needs of the sector around skills and education. R&D tax credits, obviously Paul's on the call here and things like that. So obviously, and there's just a bit of a quote that we've got from someone from the technology supply chain, which is quite an interesting read about his thoughts around R&D and I suppose the feeling around it. And obviously, the process has changed. People have been potentially claiming when they shouldn't be claiming. That's putting off people claiming, actually, when they shouldn't be, because of the cost and because of the potential sort of questions that HMRC will have. But there's a load of people missing out. Okay, so we're sort of in our manifesto, we're kind of talking around the reintroduction of the enhanced R&D relief, the 130% uplift to SMEs. We're kind of sort of asking for the funding support through sort of cyber security accreditation, UK cyber resilience. We're asking for support around training and education, and we're looking for better communication around this support as well from government. So there's a real key area. This is actually R&D if it's done well, and it's a huge part of the investment point within UK manufacturing, and it's getting too hard. It's being put into the too hard pile, and that's a real issue for us that we're sort of lobbying the government on. So there's a bit around decarbonisation and route to net zero. So just a little bit from our manufacturing outlook report, which showed 70% businesses taking steps to decarbonise in the last 12 months, and actually whether that's actually doing what it's supposed to be doing. We're asking the government here for a real kind of push on strategic kind of financial support for businesses that are actually decarbonising. We're asking them around what is the UK energy generation supply chain strategy. At the moment, we get most of our energy from outside of the UK. There are issues with that. How green is that? We talk about the CBAM. CBAM is a carbon, it's actually called Carbon Border Adjustment Mechanism. Basically, looking at what products you are importing into the UK, if they are steel, if they are other sort of core sort of products, then there could well be a tax on that that you have to pay at the border around how green that core raw material is. So there's all sorts of initiatives around here where we're asking the government to also sort of provide a reshoring initiative, to provide funding for people to reshore, and just because this is a big issue for a lot of manufacturers out there. They're being asked by their supply chain and they're being asked by their customer base to decarbonize. Actually, that's really difficult to do when most of the supply chain is non-UK, and that's a real issue that, put bluntly, no one in government really understands. So we're lobbying that at the moment as well. Again, this goes on a little bit around the supply chain and wanting a strategy around it. So importing, exporting, much more difficult than it was. I won't get into the whole Brexit thing, but it is. That's the reality of it, the paperwork. So we're asking for a root and branch risk assessment done by the government around supply chain, national infrastructure, any plans for UK steel production, manufacturing, any kind of technology dependent sort of processes, and effectively provide a gap analysis so that we know where we are now and where we need to be in the next 10, 15 years and how we're going to get there. Again, this is something that is just not thought about from the government level, from our perspective. So that's a real kind of a real push, and again, sort of thinking about the sort of promote to reshoring, which I think is a real challenge, but something we've got to strive for. So one of the other things as well is where we're kind of access to finance. We'd like a national sort of capital grant scheme for digitalisation of processes and decarbonisation. It's too difficult to get grants. No one really knows where to go. No one really knows who to go to. Everything's changed with the LEPs over the last kind of 12 months, 24 months. No one has any idea where to get grants broadly, and then when they know, it's very difficult to get one. If you're a big OEM and you're sort of, you're part of the catapults or any other sort of, the big boys, so to speak, in the industry, they get stacks of grants. They seem to get them. It doesn't actually filter down to probably 80% of the sector very easily, and that's a real push for us. So we're lobbying to give them, to basically provide a funding flowchart, which effectively tells people where they need to go for what. And we kind of thought about that mainly from back in the COVID sort of era, where Crowe provided the funding flowchart when no one really knew what was going on and where to take it from and what they were eligible for. And I think it visualized where people can go and what they can do and where they can get it from. And I think that's something that's needed from government, in particular around finance and funding. We're actually asking for also sort of funding, sort of going back a while. You probably remember is that there was some funding that was always available for to provide support in when you're getting accountants to do any funding applications or forecasts or anything like that. The rules around getting the grant funding were so difficult that actually put a lot of people off who don't have their internal finance team. And back in the days, through regional kind of funding, you could actually get accountants to actually do all of that and get funding for the fees. Little things like that help businesses that don't necessarily have a finance director and a team of 10 within their finance team, but actually genuinely are doing fantastic things that need money and are due grants. So that's something that we are lobbying as well. All right, so just I've put a little bit here, and I've sort of again, this will be sent out, but there's a little bit more in more sort of detail as to those kind of areas. There's a lot more detail within the manifesto, but we are getting real traction with this. So our head of manufacturing is Jonathan Dudley. He's based in our Midlands office. He is getting some serious traction and within government as well. And we're actually kind of pushing pretty hard. So, through LinkedIn or through direct contact with government. And so please share, please, if you see anything I think this is something that is a critical area for the firm, and we really want to make a difference within this sector. So there's a lot more detail within the manifesto. It is a great read. Those are the main sort of points, and I'll turn on to the last slide. About what we're sort of pushing for. But if you know of anybody, if you are, or if you know of anybody within this sector, then please shout and share, because the more we shout about it, the more that we can potentially make a difference. Even if one or two of those things come off, then it's worth doing it. So I just thought, while I got a bit of a captive sort of audience, then just to kind of to run through that really. All right, and then there's your QR code if you want to download and share.